I do think one of the most common mistakes that people make, not just real estate investors, but just people in general, is that they tend to think tax savings happens in April. Like when I go and meet my tax person to do my taxes, they're going to help me save taxes by, I don't know, magically writing off a bunch of stuff. But the reality is tax savings happens way earlier than April. Right now, if you want to save taxes for 2025, what you should do is meet with your CPA and tell them about your investing plans or your business plans for 2025. So they can help guide you on like how much real estate can you afford? How much should you buy? Where should you buy, to get the optimal return as well as tax benefits? How do you track your expenses, right? What is a system for you to track it, understanding what you can write off? So tax saving happens way before April when you meet with your CPA. It actually happens the year before you're doing transactions.
My name is Rodman Schley. As a real estate expert, I've invested millions of dollars in vacation properties all around the world, and I've been involved in the valuation of billions of dollars of properties. I want to share my 35 years of experience along with vacation home investment tips from the top minds in the short-term vacation rental industry. Now, let's do the work. Hey everybody, welcome to the Vacation Property Secrets Podcast. I'm your host, Rodman Schley, and today we are fortunate to have someone who's going to help us get ready for tax season. Amanda Hahn is a CPA, tax strategist, and author of the highly rated book, Tax Strategies for the Savvy Real Estate Investor. As founder of Keystone CPA, Amanda specializes in helping people using real estate to save massive amounts in taxes and keep their hard-earned money by helping educate investors on how to maximize tax write-offs, legal entity strategies, tax-efficient ways to access profit, and how to use 401k money for real estate and much, much more. Amanda, welcome to the show.
Yeah, thank you. I'm excited to be here, Robin.
Now, this is really great, and it's very relevant. We're coming up on tax season, and a lot of people who are real estate investors know that there are so many different advantages that we can take advantage of when it comes to real estate and the things that we can deduct, the different ways that we can build wealth. And I'm really excited about our conversation because you're the guru. You are the professional when it comes to this. Can you give everybody a little idea about your background?
Yeah, sure. What I tell people is I'm a CPA by day and real estate investor by night. So like many of our listeners, real estate is also my preferred wealth vehicle when it comes to just like, building wealth and things like that. So I actually started out my career at one of the big four public accounting firms. And I just happened to end up in the real estate specialty group. So early in my career, I worked on a lot of large real estate investment firms, developers and things like that. So kind of got a first hand insight into the power of tax savings that is offered to real estate investors, but never thought I would invest myself. It was actually my husband who read Robert Kiyosaki's book, who then said, hey, we should invest in real estate. And I basically thought he was crazy. It's like, I'm a CPA, I do taxes for people. I don't know anything about real estate investing. But yeah, now years later, I'm so glad we did.
Yeah, so you talk about being that by day, that CPA, but a lot of people don't take what they learn and then actually execute on it. Like I'm a valuation expert. I've been in the appraisal business forever, and I understand the procedures, the methodologies, how to go in and value things. But a lot of those folks don't use those methodologies and the things they know to actually execute on them in the real world. And so you're kind of doing the same thing I am. You're going out there and saying, I've got all this knowledge, I've got all this experience. I know that I can build wealth through real estate. So I'm going to take my knowledge and I'm going to utilize that tool and that vehicle.
Yeah. And I think even for me, though, it was still scary. I think people are thinking like, oh, you know all the numbers and, you work on these big real estate companies. It must be very easy for you. But yeah, I think for me, I was like any other new investor. I was really scared signing the first purchase agreement, just wondering if I know what I'm doing. But I think it just takes that first step. Sometimes it's you just learn from your mistakes if there were to be any.
Yeah. And it can be intimidating. I mean, when you're getting into new things and when you're trying to execute on theory and what those first deals can be definitely intimidating. But once you get into it, you feel good, you understand it, you know more than you think you know. But everybody has to start at square one, right? And I always think about those people. We talk about the tax advantages that we can take advantage of, but at the same time, how many people do you think really are taking advantage, full advantage of their taxable write-offs?
I think that most people think they are, but they're probably surprised to know. In our firm, one of the first things that we do when we start working with a new client is we look at their prior year taxes, right? We want to know how it tells us a lot about someone. What did you own? What were your strategies? And we've recently taken a look, and about 40% of tax returns that we review are not optimized for tax
Mm.
savings. So, much higher percentage than I would have thought or wanted it to be, but it was the first time we kind of started to take a hard look at it. And I think a lot of that is just maybe investors assuming or relying on their CPA to be doing the right things, when the reality is that not all CPAs understand real estate. Most CPAs work with all types of clients. And, the whole concept of real estate taxes is like a little niche within this big, gigantic monster of the internal revenue code.
Yeah, yeah, for sure. And I could totally see where some people would think they're taking advantage, but and what do you see as the most overlooked? Is it cost segregation, or what structures are they missing out? That if you've got 40% that are missing out of those, if you say they're really the majority are missing this big chunk right here.
hmm I would say three main things. One category is probably missed deductions. So oftentimes, whether it's the investor or the CPA not capturing all of the legitimate write-offs that investors can get. I think everyone's pretty good about interest, taxes, management fees, right? Everybody gets that. But it's a lot of these overhead expenses that we have. Going travel to the property or any educational, professional development costs. Those are missed quite a bit. Cost segregation, depreciation is a huge one, just not being optimized. I think we all hear about accelerated depreciation, and maybe people assume that their tax person is doing that. But I always tell people, don't assume, to all of our listeners, don't assume you're doing it. Ask your CPA, am I taking accelerated depreciation? How much am I actually saving in taxes by doing that? Because it forces your tax person to say, oh, have I looked at this specific strategy? And I think the third bucket, which is not as many people, but the third bucket, probably I would say legal entities. Sometimes investors are operating in the wrong type of legal entity, and sometimes it, ends up costing them some tax benefits.
Yeah. Well, let's talk about cost segregation just for a moment. So some people might not know what that is. Of course, we all know what depreciation is, but I know that when you look at your property, cost segregation is a biggie, especially right out of the gates when you buy the property. Can you talk a little bit more about how that is structured and requirements? I know that sometimes you need to have a study done, but I don't know if there's other methodologies that you can use to still get the same advantages. But I'd love to hear your take on that.
Yeah. So cost segregation, basically the concept of it is, instead of just taking regular depreciation, if we're talking about residential properties, it's 27 and a half years. If we're talking about commercial real estate, we write it off over 39 years. Cost segregation is basically when you have an expert come and do the analysis of the building and say, well, this is not just a $500,000 building. It's actually made up of a lot of different components of specialty plumbing, specialty electrical, and then your CPA can depreciate them faster because they're not part of that building anymore per se. So whether it's done by a special cost seg firm or sometimes, very rarely, but I have seen CPA firms actually do it. You just need someone with a good engineering background who understands the breakouts of, the ability to really break it out using the guidelines by the IRS. So that's pretty much it. The times when we have clients do it, I think this is a common misconception that people think, hey, I own real estate, I should do cost segregation. But that's not necessarily true. The strategy only works in some cases. Ultimately, you'd want to know first, do I benefit from a cost segregation study? If so, how much am I going to benefit? In other words, how much taxes am I saving this year? And then I want to compare that to the cost, because those studies aren't free. So I want to know, what is it going to cost me to get it done? And then as the investor, you can make a decision. Do I want to go ahead and do that for this year or not? Or do I want to save it for a future year where I can get the optimal tax savings?
Yeah, and you're still going to pay taxes upon the resale unless you do like a 1031 exchange and roll into another property or such, which a lot of people do. So it's not really you taking a deduction up front, but then on the back end of the deal, correct, is when you're going to have to come to the table. I mean, obviously, if you have a property that you've depreciated and you bought it for $500,000 and you buy it for $750,000, how much depreciation do you really have, right? You actually made money on the property. So I think that a lot of people think maybe it's a deduction. Instead of it is a deduction, but it's one of those things that over time is going to come back when you go to resell the property.
Yeah, and it really comes down to the numbers. That's why the cost segregation is not beneficial for everyone the same. So you could be someone in a very low tax bracket right now where the benefit to you might be 20%, 25%. Or you could be someone in a very high tax bracket where you're saving, close to 40% in taxes by doing a study. But what I love about, cost segregation is that as an investor, you don't have to make that decision by yourself. You have your CPA, you have the cost segregation experts. And in fact, you don't have to spend a penny to know what the cost benefit is, because for all the companies who do it, they give you a free estimate. So you never have to say, oh, well, let me just put some money in this project and then later to find out I did or didn't save enough taxes. Right.
Yeah, and just the word cost segregation kind of tells you a little bit about, instead of taking like a straight line over the holding period or whatever it might be in depreciation, it looks at each component in the building. So yeah, you might have a furnace, and I don't know what the lifespan of a furnace is, but instead of being a 30-year span that equals your mortgage, it's maybe a 10-year span, so you can depreciate it at a quicker rate. Is that correct?
Yep, exactly.
And looking at all the components in the building.
Yeah, yes. And something that interesting that you brought up about, when a lot of investors think it's creating write-offs, but it's actually not. It's just accelerating a tax benefit from the future into this year. So really the question to ask is, is it worthwhile for me to save more taxes now rather than to wait over the next 27 and a half years to save tax? I think for most people, they'll say yes, right? Because the time value of money, I get to have my money now, I get to invest it rather than having to, pay the tax now and wait for the benefit down the road. But I always tell people, before you go out and spend money on a cost segregation, first talk to your CPA, find out if it's right for you, and then get a cost benefit done for free to see if it makes sense.
Well, I think what I love that you're saying the most right now is the fact that you're saying there's no one size fits all. Sit down with somebody, do some planning, figure out what's going to be most beneficial for you as an investor under your current circumstances. And I think a lot of people think there's a one size fits all when it comes to this, and it's just not true. Everybody's looking, everybody has different needs. Everybody's has different options that they can take advantage of or shouldn't take advantage of. And I think that's the main thing, is like at least sitting down with somebody to hear about what's going to be most beneficial in your circumstances.
Yeah, and I do think one of the most common mistakes that people make, not just real estate investors, but just people in general, is that they tend to think tax savings happens in April. Like when I go and meet my tax person to do my taxes, they're going to help me save taxes by, I don't know, magically writing off a bunch of stuff. But the reality is tax savings happens way earlier than April. Right now, if you want to save taxes for 2025, what you should do is meet with your CPA and tell them about your investing plans or your business plans for 2025. So they can help guide you on how much real estate can you afford? How much should you buy? Where should you buy? To get the optimal return as well as tax benefits. And then how do you track your expenses, right? What is a system for you to track it, understanding what you can write off? So tax savings happens way before April when you meet with your CPA. It actually happens the year before you're doing transactions.
Yeah. So let's talk a little bit about, we talk to a lot of people who are just getting into buying vacation homes. They're just getting started, trying to figure it out, trying to learn the ropes, just like you when you made your first investment, or me when I made my first investment, right? You've got, your eyes are huge. You're trying to sort everything out. You're trying to reduce risk as much as you can. You're trying to make good decisions. Should they be sitting with you and doing planning before they've made this purchase to get an idea of what their life is going to look like? Or should they get that purchase made and then go, here's what I've got, now what?
Yeah. I mean, the answer to that question also depends on who's asking the question. I feel like if there's not a budget concern, the sooner you start doing tax planning, the more options you have. And that's really what planning is about, is give me the options on how to maximize my investment, maximize my tax savings. So yes, planning before you buy your first property could be super powerful, because you could buy your first property in the wrong type of entity or the wrong property, in which case you might be, costing yourself a lot of unnecessary taxes and headache. But I also feel like if money is a concern, I only have a specific amount of money, um, then I tend to tell people buy the real estate first, because I hate seeing people who spend a lot of money on tax and legal stuff.
Mm.
And then it's like, I don't have enough money to buy real estate.
Yeah.
So we always want to keep in mind, like, our first goal is to own real estate, build wealth. So yeah, so the answer is it depends. It depends on what you're working with.
Yeah, I would say though, you brought up the legal entities in which you're going to buy the real estate. I mean, that's right out of the gates. You really need to know, make sure that you buy that under the proper, whether you're going to do, and again, not to give anybody any advice here, but, get that LLC in place, or get something that's going to be most advantageous for buying the real estate. Some people might even, I don't know, some people might go into an S corp, but the majority that I see go and get a limited liability corporation in place. But understanding what it is and what you personally need, I think would be step one, because it's hard to go back after you've bought that property and put it in the name of a corporation to make those changes.
Yeah, for sure. And if you're someone who's really big on like privacy, once you buy the property, it's recorded at the county in your personal name, so you can change it into an entity later on, but that history of your name being attached is going to be there as well. Something interesting, you said that, a lot of the listeners just own a vacation property. But I think it's really important for people to understand that whether you have one property or two, or whether it's a vacation rental or a regular long-term rental, you always want to treat that as a business. And so don't think like, oh, it's just a vacation property. Maybe I don't need to track my write-offs. Maybe I don't need to do some planning. I would, treat it like any other business, because real estate is not cheap, right? So even one vacation rental is probably a lot more expensive than someone else who's just starting a business selling things on Amazon.
Yeah, you're totally speaking my love language right now, because, so many people come in and they go, and I get it, it's a vacation home, right? So people think, hey, this is my personal vacation home. I'm going to rent it out a little bit, maybe to cover some of my costs, those kind of things too. So, but I always tell people, it's like, no, 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 no. It's just not like that. You got to treat it like a business, because there are so many things that you can, like you said about like education, there's so many things that you wouldn't even think about that you could write off towards reducing your tax liability on the property, that you're silly not to put into a business and run it like a business.
Yeah, for sure. And I would also say too, because I know a lot of people, they want to buy a vacation home, part of that element of personal benefit, right? Because maybe I like visiting there. Maybe I'm going to take the kids there to ski and whatnot. But when you're doing true tax planning, it is important to be proactive in how much time you're spending there versus how much time it's actually a rental, because it could have a very significant impact. If the property's primarily your vacation house, and then from time to time you rent it out, then you're not getting all of the tax benefits of like a true, short-term rental vacation property. But there are things you can tweak to say, maybe this is the year I want the tax benefit. I'll limit my personal use. And then in a couple of years, it's primarily, a second home for me. So a lot of different intricacies on like how you use it, when you use it. But I think that's the beauty of being a landlord, right? Because you own the property. So it's 100% up to you how you want to use it, how frequently you want to use it, and whether tax savings is, important enough for you to try to navigate that piece of it.
Hey, everybody. I hope you're enjoying this episode of the Vacation Property Seekers podcast. I want to let you know about one question that I get all the time. And that's, how do I forecast my cash flow and my profitability when investing in a vacation home? Now, if you've ever wondered that, or you know somebody who has, you're in the right place. We've created a free training called Financial Forecasting for Maximum Vacation Home Profitability. Now, in this training, we're going to guide you step by step on how to accurately project rental income estimate your operating expenses, and calculate your returns so you can make informed investment decisions. You can access the free training at vacationpropertyexpertnetwork.com. So if you're ready to dive deeper into financial fundamentals and maximize your profitability, visit vacationpropertyexpertnetwork.com. What do you think is the biggest mistake that people are overlooking or that they're making on their investments?
Oh man, investments in general, like
Well, on
outside
their
of
real estate
taxes.
investments, on the tax side, like what are they missing? Like,
Oh,
I know that
tax
we
side.
talk a little bit about a few of the things, but like, what's that big one that you go, man, I see this happen all the time, and people are just missing out on this opportunity, tax wise.
Yeah, I mean, if we're talking about vacation rentals, the biggest and most common mistake I see is actually not made by investors. It's actually made by CPAs. And this is a scary thing to kind of talk about as I say it out loud. So generally for vacation rentals, we're talking like Airbnbs, Vrbo, things like that, where the average guest stay is maybe 7 days or less, right, for a guest to check in, check out. And in the tax world, there's this concept of short-term rental tax loophole, where if you have a short-term rental, you can keep your full-time job. Real estate could be like a side thing, and you can create these tax benefits and tax losses and be able to use it to offset taxes from your W-2 income, from all types of income, including retirement income. We call it a loophole because in traditional investments like long-term rentals and midterm rentals, you or your spouse has to be a real estate professional in order to use the rentals against W-2. But in the short-term rental space, the IRS doesn't care how many hours you're working at your job. You just have to meet material participation. The short-term rentals go against all types of income. But it's such a small piece of the tax code that, again, unless your CPA works a lot in real estate and specifically in the short-term rental space, a lot of times they don't know, and they default to the rule and tell clients or investors that, hey, you don't get to use this benefit because real estate is not your full-time gig. So I think the caution here is if you're investing in vacation rentals, short-term rentals, where the average guest stay is 7 days or less, and your CPA is talking to you about how many hours you're working at your job or you make too much money to benefit, that's a red warning sign that CPA doesn't really know the rules around vacation rental tax benefits.
Mm. And so if somebody runs into that situation, they should either change CPAs or is it worth educating or pointing that out to a CPA and saying, hey, you really need to look at this part of the tax code to understand it? Or, I mean, if that red flag came up for me, I would start to question all the other things that they might be missing in the equation is my problem.
Yeah, I mean, we've seen both. We've had clients, a lot of clients that we do tax planning for, and they have like they prefer to work with a local CPA, or like their CPA is like their father-in-law, right? Like they can't hire them. And so, yeah, sometimes it's that conversation about, hey, I was made aware of this loophole. It's called a loophole because it doesn't default under the regular rule of comparing your work hours. And yeah, but if you're not super connected to that specific CPA, like they're not your father-in-law, you can't get rid of them. I tend to agree with you, Rodman. It's more of like, well, then what else are they missing that they don't know about real estate? At the end of the day, you as a taxpayer, you don't want to be the one giving advice and tips to your CPA. That's their job, right? Your job is simply to keep them updated on what you have going on, what you want to do with your finances, your investments. And from there, they're the ones curating the strategies like, hey, consider this. Have you thought about that? Let's move it to this kind of entity.
Mm. What is one of the best benefits if you were going to tell somebody, it's like, you could miss everything else. Don't do that. But this one benefit or this one tax benefit is so important that you make sure that you lock in, that you understand, and make sure that your CPA also understands this. What would that one be?
I mean, I think it's going to be the same, right? The opposite side of the coin is like if you are investing in vacation rentals, and you still have a full-time job where real estate is just your side hustle, make sure you get a clear understanding of what are the things that you need to do as an investor to legitimately take advantage of these short-term rental tax loophole benefits. Because simply by investing in a vacation property doesn't mean I automatically get the benefits. I still need to make sure I'm doing the right things during the year so that I could use the benefits or the tax savings to my benefit. When we were talking earlier about people who do long-term rental investments, you have to be a real estate professional to try to use that against W-2 income. But in the short-term rental space, we don't care about your work hours, although you still have to meet material participation hours. So I definitely, for someone investing in vacation rentals, you want to get clarity into what does that mean? How many hours? What do I have to be doing? So, if this is new to you, you can check out my YouTube channel or go to my website. We have a lot of great free information about that. But at a high level for short-term rentals, you want to have at least 500 hours in your short-term rentals. Or if you don't have 500 hours, you can also earn at least 100 hours as long as no one else has more time than you. So comparing your time with like the cleaning crew or landscapers, if you have more than them and you have at least 100 hours, you could also potentially use this tax benefit against W-2, stocks, crypto, dividend income.
Listen, if you don't have over 500 hours in your short-term vacation, I want to know how you're doing it because it's a lot of work. It takes so much time and so much energy. And that comes back to why I always tell people, this is a business, folks. This isn't just, you're not just going to have people coming in and out. It's going to be an easy thing. It's not like an office building where I sign a 5-year lease and I might check in on somebody once or twice a year to see how things are going or maybe do a repair. I mean, it is ongoing management, ongoing handling things, ongoing maintenance. So if you're not getting 500 hours in on your short-term vacation rental, you're probably either not making much money because you're contracting everything in the world out, or B, your property's falling down. One of the two.
And you're also not making a lot of money.
No, exactly. That too. No. So let's talk a little bit about exit strategies. I get a lot of people asking me, well, what happens at the end of the hold? So a couple of things, when you're dealing with a vacation home, a couple of things happen. Sometimes a family has a vacation home for a long time and they want to pass it on down to their kids. It's been their place too, their kids' place. How do they handle something like that, particularly when it's in say it's in an entity instead of being personally held?
The answer to that also, again,
As it
depends
depends,
on the
doesn't it?
investor. Currently we have a pretty high estate tax exemption, right? And so I think right now this year it's about over $13 million, which means as an individual, the first roughly $13 million that I pass down to the next generation, there is no estate taxes involved. And the benefit of passing a property upon death is that we get what's called step-up basis. So if I bought a vacation rental for $100,000, by the time I pass away, it's worth $1 million. If my kids or grandkids inherit the property, they get it at $1 million. And so if they were eventually to sell, that first $1 million is tax-free, basically to the whole family. So if you're someone, if you're married, that's double that, right? So like $26 million of exemption. So if your net worth, which is, just everything you have, is under that amount, then typically we recommend passing it upon death. So, put in your trust and then the beneficiaries will be the kids or grandkids later on. If your net worth is above that amount, then that's where we get into some more advanced trust planning stuff. So you might start, like in an entity, you might start to shift ownership of that LLC over time to start gifting and shifting some of that to the next generation. So two kind of opposite strategies depending on whether your net worth is below or above that lifetime exemption.
If you're above that, is everything become taxable or does it go up to a threshold of say the 26 million? Does the taxable event start? Like say you had a husband and wife, 26 million I think you said 26 million in exemptions, up to, but if I'm exceeding that, are my kids not paying taxes on that first 26 million and then having to pay the estate tax
just on the top?
On top
right. So we still get to all use our exemption amount, right? So let's say it's 13 million a person. And my net worth happens to be, 14 million. So I'll pay tax on that additional $1 million. That's above my lifetime exemption. And that will change too, depending on what happens in Congress this year, that, it automatically could go down to even half of that starting as early as next year. So tax law changes all the time. That's why it's good to have a good CPA because, unless you're someone who's like a super nerd and really interested in all the different changes. But, one thing I always tell people is like, don't haphazardly start adding kids and grandkids to title because people tend to do that, especially with primary homes and
Yeah.
vacation homes. They're like, oh, I don't really need it. Let me just add you to title. When you do, a lot of times what you're doing is taking yourself out of that tax-free step-up basis. And we see this happen all the time.
So don't, like, if you have a house, don't necessarily even write it over to your kids while you're still alive because you're not going to have access to that exemption. Is that what I'm
Yeah, I
hearing?
mean, you just want to make sure you talk to your tax advisor before, you just start putting them on title. Because then your tax person can advise you on, like, what does that mean? And I share this because it was a personal story because my mom added me to title of her home
Mm.
several years ago. And then I don't know, at some point I somehow found out about it. And I said, please remove me from title because this is what I tell people not to do. But, it's one of those, I think a lot of parents, they just do it. They feel like, well, I'm getting older and I just want you to have everything anyway. So might as well just add you to my title.
Yeah, no, I think if I start adding my kids to my title, they're going to try to knock me off. So,
Yeah.
I'm going to not do that. I think that for my safety and my wife's safety, we're going to make them
Love it.
wait. We're going to make them wait. Plus, it'll
Love
chance
it.
to pay the houses down a little bit more. They'll get, they don't want to acquire that debt. They need me to be alive to be paying that thing down for them.
That's another viewpoint for sure. Yeah, it's like life insurance, insuring your life.
Exactly. No, I don't think my kids would really I don't think they would knock me off, but I don't want to give them any ideas either.
Yeah.
So,
But now we have it we have it recorded.
yeah, exactly. Yeah, if something happens to me, I want you all to investigate, try to figure out what's going on there. So, how long have you yourself been investing now in real estate since you've got in?
Oh my goodness. So we started investing around 2008,
Okay.
around
That
the
was a
same
good year to
time.
start investing, by the way. That was right
Yes.
during the bank crisis. I always tell people, anybody who bought in '08 and '09 are probably very
Yeah.
happy campers that they bought in '08 and '09.
In hindsight, yes, but at that point in time, it was quite scary. My husband and I, we both worked at Deloitte, which is, one of the big four firms. And around that time, we decided to leave our job, start investing in real estate, and start a CPA firm focused on working with real estate investors. So you can imagine the craziness that went through our head when, real estate market crashed and we're like, was that a good life choice? But yeah, you're right. I mean, now looking back, it's like, man, we should have bought dozens more of those same properties, right? But back then, even one was like, oh my goodness, can we actually do this?
Now, we're brilliant when it comes to hindsight all the time, right? And I always tell people, if I would have bought $1 million in real estate back in '08 and '09, we bought some
Yeah.
real estate, but it would be, I saw houses that are selling now for over $500,000 that were selling for $100,000. And that
Yeah.
was not that long ago, right? I mean, it's just kind of like, and the real estate markets are so cyclical that you just got to, you never get to time everything perfectly, but a lot of time, and Warren Buffett will talk about this all the time, you want to be buying when everybody else is afraid. And you want to be taking advantage of markets when they're not performing well. And people are afraid because, that's when you're going to get the deals. That's when you're going to get the discounts. And it's going to cycle back. I want to say, I am going to say it historically always has. There's no guarantees in the future, but long-term real estate is just such a great way to build wealth.
Yeah. And I think people always hear, like buy when everyone is fearful or invest when everyone's fearful. But for a lot of people, it's hard to internalize that message. So even today, we always have clients who are like, should I buy? Market is softening. But, I think it's important, that's why it's so important to look at the numbers when you're investing. If you're a new investor, what I always talk to clients about is like, what is the worst case scenario? Like, if this cannot operate as a vacation rental, it must be a long-term rental. What do the numbers look like? Can you sustain those numbers? Or if it's vacant for a year, can you still afford to keep it? Because once you know the worst case scenario, and if you're okay with that worst case scenario, then it's a much easier decision than just sort of, subjectively think about all the crazy things that could go wrong and really not taking action as a result.
Yeah. Well, and I think, it's been interesting. I always talk about how COVID was really good for short-term vacation rentals. Rents were up, vacancy was down because people were, they couldn't go anywhere. They were at home, but they could go to a short-term vacation rental and park for a month and change up their scenery, right? And then all of a sudden things went back to normal and it became a lot tougher of a gig. It's going to be really interesting right now because I know a lot of what's happening with our political situation and the tariff situation and things that we're doing right now. Like Canada's basically saying, don't travel to the United States anymore. There's a lot of countries like that saying, don't travel to the United States. And it's going to be really interesting to see what impact that has on our tourism and our economy when it comes to people traveling and staying at short-term vacation rentals in the United States. And if it becomes difficult, again, that's just going to create more opportunity for really strong operators, people who understand how to be good at it, how to go in and buy a property right, how to make sure they're managing it right, and to buy right. I think it's going to provide a lot of buying opportunities for those who are really good in the marketplace.
Yeah, I think we're seeing some of that even now. I was just talking with a client about short-term who has a lot of short-term rentals, and they were saying that some of their competitors didn't do as well because they were just more hands-off. And a lot of people last summer, at least, were traveling abroad, right? Going to Japan, going to Europe. And that took away from what, their typical guest profile would be. So, yeah, I agree 100%. But if you're someone who understands how to operate it, have a good product, then you can sort of dominate that market area because the competition is leaving quickly.
Yeah, 100%. And I will say this too, because I invest down in Costa Rica is where I like to invest. And I will say that my occupancy is going crazy right now. I memean, it's been like, again, a lot of Canadians go down to Costa Rica, and if they're not going to come spend the dollars here in the United States, I think I'm a beneficiary of a lot of those people who are still going, I want to go somewhere. Let's go down to Costa Rica. So I always tell people too, it's always smart to diversify. Some markets are going to perform not as good as other markets, and sometimes they're going to be up, sometimes they're going to be down. But just make sure that you're smart in your investing and make sure that you're buying right, and know that it's not an easy lift. None of it's an easy lift. You got to be prepared for the ups and the downs. And like you said, being a really good operator and being somebody who's good at what they're doing can outperform and sustain in those down times. I mean, I want people to find you because I think you're a wealth of knowledge, and I think that'd be great if people could reach out. A lot of people that come and listen to the podcast are in the beginning stages. They're trying to figure it out, but it'd be great to have them have an opportunity to sit down with somebody like you and do this planning. So where do they need to go to find you?
My firm is called Keystone CPA, and so you go to keystonecpa.com. We have a lot of great free information on there. And if you are looking for, if some of the stuff that we talked about today was sort of new or newer to you about real estate professional and the different hours, I also have a YouTube channel as Amanda Han CPA. We try to put out pretty detailed content weekly. And if you want daily tax tips, because you just love it so much, you can find me on Instagram as Amanda Han CPA.
Hey, I would prefer the tax tips than a lot of the stuff I see posted online these days. So I tell you, well, that's great. So if you could go back, just one last question, and I ask this of everybody, and if you could tell that person who's just coming into the business, who's just getting started, maybe they're like you, where they're a little scared as 2008, trying to figure out, is this going to work for me or not? What would be your one piece of best advice that you could give to them?
Oh man, best advice. I would say educate yourself, empower yourself with knowledge from people who've done it. But after you have sufficient knowledge, make sure to implement and don't get stuck inside of the analysis paralysis stage that many investors get trapped in. So yeah, it's scary. I think it's always going to be scary. But once you take that first step, it becomes less and less scary every step thereafter.
Love it. Amanda, thank you so much for coming on today.
Yeah, thanks for having me.
Of course. Thank you for tuning in to this episode of the Vacation Property Secrets Podcast. If you enjoyed the show, we'd really appreciate it if you could leave a rating and a review on Apple Podcasts or Spotify. By leaving a review, you not only support the show, but you also help others find and enjoy it just like you did. Also, please share this episode with somebody who could benefit from it. And if you're aiming to build a short-term vacation rental investment business that's based on strong investment fundamentals and not just emotion, I'd love to invite you to a free training that I'm hosting. It's my financial forecasting for maximum vacation home profitability training, an on-demand video course that's completely free. It walks you through the investment fundamentals to build and scale your short-term vacation rental business. You'll also learn how to estimate investment income and your operating expenses to build a projected pro forma operating statement and the potential NOI and return on investment for your property. Just go to vacationpropertyexpertnetwork.com to get access to your free training. We'll see you next week for another episode of the Vacation Property Secrets podcast.